Welcome back to Letters of Intent, where we explore the intersection of law, business, and innovation. I'm your host, Pankaj Raval, founder of Carbon Law Group. And today I'm joined by my colleague and co-host, corporate attorney here at Carbon, Sahil Chaudry. We are diving into Sahil's recent trip to India, a trip that lined up with some pretty big news in the world related to tariffs, IPOs, and what it all means for companies who are raising capital. Sahil, welcome back.
Thanks, Pankaj. I'm excited to share.
Yes, I'm sure there's a lot of great news and interesting news to share from your time in India. We live in interesting times and there's a lot going on in the world, but particularly with U.S. India relations as well. So, let's start with your trip. India obviously holds a dear place for both of us. We spent time there. Even while born in the U.S., we spent both at least a year there volunteering, and now you're back. Tell us, what brought you back to India?
Yeah, Pankaj, you're right. I mean, we met through a program called Indicor. It seems like India keeps calling us back. And this trip, India called me back in a really remarkable, memorable way. So my father-in-law, Anand Pandit, he had his IPO of his company, Sri Lotus Developers. And I got to visit the National Stock Exchange in Mumbai for the ringing of the bell. The subscription window was July 30th to August 1st. There was a price band of 140 rupees to 150 rupees per share. But literally on July 30th, the same day subscriptions opened, President Trump announced a 50% tariff on Indian goods. Yeah, I mean, this was huge. This is a major flip in terms of India-US relations for the last 20 years, where it seems like things were moving in a more collaborative direction.
Yeah.
And so this was a result of the new Trump tariffs and specifically targeting India's relationship with Russia.
Interesting. So tell us more about that. So what exactly is the relationship between India and Russia?
So, in a nutshell, India buys Russian oil, and President Trump is alleging that purchase of that Russian oil is funding the Ukraine war. So, that's the narrative that's being created around India. But for other people who are maybe in the school of more realpolitik, it could be more about balance of power politics and trying to balance out the US's dominance in the world.
Wow. So it sounds like, yeah, probably a lot of mixed emotions when you're in India for a celebratory milestone and all of a sudden you have this global trade bomb dropped on India. Did it crash the party or you managed to still have some fun?
We thought it might crash the party, but it didn't. In fact, analysts were really worried that the markets would turn choppy, but when Lotus listed on August 6th, it opened around 178 rupees, well above the price band. So that showed investors believed in the fundamentals despite the tariff shock.
Interesting. And when you say it opened above the price band of 140 to 150, can you tell us a little bit more about what does that mean to a layperson in terms of how a stock is priced and what causes it to open higher as come trading day?
Yeah, absolutely. Initially, the stock is priced for its IPO, which means there's a certain allocation of shares that the company is willing to sell into the public market. And the initial buyers of those shares are the people who buy into the IPO. Now, once that bucket gets full, that's called being subscribed once. Now, in this case, Lotus Developers was subscribed multiple times, way more times over than the initial allocation. And so that gives the market an indication that the price of the shares was under what it could be in the marketplace.
Hmm.
So when it was listed, it gets listed for the public at 178, meaning everyone who bought into the IPO is making a profit if they choose to sell into the public market. So it's a great sign showing that the market believes in the fundamentals. And this is a very interesting time for India because despite the tariffs, the Indian market has stayed very resilient. And there are many who describe 2025 as an IPO boom year for India. So the public equities markets in India are very strong. There's a lot of confidence. That means that there's going to be a lot of business between India and the rest of the world, despite the tariffs. I mean, in fact, kind of the lack of impact so far of the tariffs on the Indian markets shows that there's a lot of flexibility in terms of the Indian economy. Even though it's been based on a manufacturing economy for the world, there's actually a huge consumer power in India that I think we're going to discover.
That's fascinating. Yeah. I mean, you would think that for the last maybe century or maybe 70 years, America seems to have been the place where everyone wants to come and sell, right? There used to be a huge consumer class. But I think what we're seeing now in this global trade world that we're living in, that the middle classes of India and China are growing significantly. And now maybe the power is really tipping maybe in their favor.
Yeah, I think it's kind of yet to be seen how quickly that can happen. But I do think that the way, especially the BRICS nations, have rallied together and have started posing a challenge to American dominance, I think it's not like you said, it's not the world it was even 10 years ago. We're living in a more multipolar, multilateral world. And I don't know if there's as much room anymore for an economic bully.
Yeah,
So
interesting.
yeah, but that was, it was all in the news. We were kind of at the edge of our seat seeing what was going to happen with the stock, but it did really well. It gave me a window into IPOs and capital markets, which is something that we do. And it gave me a window also into how flexible our clients need to be because all of a sudden, overnight, you've had a really great trade relationship between the US and India for years. But I think the message I'm coming back with is anything can happen at any time. I mean, I think we were all very surprised with these new tariffs. I think a lot of our clients may even be wondering, like, where does the president get the authority to impose tariffs like this all of a sudden?
Yeah,
Seems kind of dictatorial. It seems like, shouldn't this have to pass through the Congress, through the Senate?
yeah.
So the source of authority here, we've got Section 301 of the Trade Act of 1974, which accounts for retaliation against unfair trade practices. So if the president believes that a country is imposing an unfair trade practice, for example, a trade imbalance is what President Trump cites often with India, they can use this to impose a tariff. Section 232 of the Trade Expansion Act of 1962 on national security grounds, the IEEPA, the International Emergency Economic Powers Act, in times of declared emergency. In this case, the administration used Section 301, tying it to India's energy trade with Russia.
Interesting. Interesting. So once these tariffs are actually announced, what happens? I mean, do they automatically go into effect? What's the next step once these tariffs are announced?
So, the USTR, which is the US Trade Representative, publishes the tariff schedule in the Federal Register. From the effective date, Customs and Border Protection collects the duty. Importers don't get to negotiate. If your product's HTS code is on the list, you pay the duty when goods clear customs.
Interesting. And compliance, how does that work?
So, the first step that we would advise our clients is to know your HTS codes. That's the Harmonized Tariff Schedule Classification. Step two is to update the customs documentation and make sure your broker is filing correctly based on these updated tariff rates. And step three is plan for cash flow because the duties are due at entry. And these tariffs I'm talking about, these are on top of the pre existing duties. So if you
Mm,
were already paying 20%, you're now, let's say, on an item coming in from India, you're now paying 70%. And that's on the cost of your goods.
wow. Are there any ways around this? I know I'm sure people try to get creative, or is it just too bad you have to pay the tariff?
Well, I mean, there are some relief valves, but it's not easy. The first is the exclusion request petitioning the USTR to exempt a product if no viable alternatives exist. The second are foreign trade zones or bonded warehouses, so goods can be stored or processed without triggering duties until they officially enter US commerce. And three, tariff engineering, structuring supply chains or product components to fall under unaffected codes. So, for example, raw materials can come from one place, assembling the parts somewhere else. There are ways where you could work with a custom specialist or your broker to ensure that you are getting the lowest tariff rate possible.
So what's the bottom line for importers? What do they need to know right now?
The most important thing is to be aware of what your HCS code is. Don't panic, but don't be passive. You do need to understand your exposure, go in with your eyes wide open, engage your advisors early. So, your advisors, that's going to include your attorneys, your customs brokers, your CPAs, and pursue the exemptions if they apply. Because in this day and age, flexibility is everything.
Absolutely. Yeah. I mean, you definitely have to be nimble, it seems like, in this market because things are changing so much. They really could affect your margins significantly overnight when these new laws are passed. The uncertainty can make a challenge for a lot of companies. Google, these bigger companies, Apple, are trying to shift operations, but it's not that easy, right? You can't just move a factory overnight to another country. That means also, I think, diversifying supply chain, having multiple sources for your supply chain. I mean, that's been suggested for a while, but I think it's indicative of when there's unrest, when there's kind of chaos in the world, you've got to be prepared to have multiple sources of inputs for your products.
I think that's right. In fact, that's probably the most damaging part of what these tariffs did with the India US relationship is damaging the sense of certainty with trade relations. You're right. Business relies on certainty. So the more uncertainty that gets introduced to the market, the more that we need to advise our clients to stay flexible because we need room to maneuver here. And the good thing is there are a lot of tools now that make it easier to maneuver than ever before. I mean, we do have today the communication systems are way more efficient. You've got video and audio and the internet and AI, and you have ways today to adapt to this uncertainty, but it's best to go into it with your eyes wide open and be ready to move and maneuver. I think you also hit on another point, which is supply chain and customers. Yes, in one sense, I would say previously, especially if you're in the US, you're sufficient or you're satisfied with the American market. You're importing goods from overseas. But today, that might not be enough with what's happening in the US in terms of inflation, middle class is getting squeezed. In terms of the consumer economy, yes, the American market, very important and maybe arguably the most important. But there are many other markets, Europe, South America, Asia, where those economies are getting activated and they're not just manufacturing economies anymore, especially when we look at, let's say, South America or Asia. You have full blown blended consumer manufacturing economies that are growing and very bullish. And so I would even advise our clients to say it's probably not a great idea to only be focused on the US or just to be thinking in this model of I'm going to buy from overseas and sell in America. I mean, today I think you need a global perspective. You need backups in terms of your manufacturing source and your customers too.
Absolutely, absolutely. Great points. And now let's turn back to, the reason you went to India, the original reason for the trip when until these tariff issues, may have created a little shadow on what you actually were there for. Turning back to the IPO. Well, first off, congratulations. Seeing Sri Lotus developers list above the ban in the middle of tariff headlines must have been surreal. Tell us a little bit more about your experience being there, being in the whole mix of it. What was it like? I know there's probably some celebrity influence there as well that you must have had some fun with. So tell us, how was that experience?
Yes, Pankaj, it was so cool. Congratulations to Aisha's family, specifically Aisha's dad, who built this company from a small garage. It was an inspiring moment, felt like a once in a lifetime experience. The energy was electric. I didn't get another shot at, auditioning for anyone for Bollywood, but I did get to meet some really cool
Don't give up.
celebrities. Yeah. And that was great. It was great to see. I think when you see someone achieve something that you've only seen on TV or in movies or read about in books, and you get to be there in real life, it was a very surreal experience. It was so cool. And I just feel grateful I got to be a part of it.
That's awesome. That's awesome. And for listeners who don't know what IPOs are, how they work, you're not experienced with securities laws, tell us what is an IPO? Why is it important? Why is it relevant in today's world?
So, an IPO or initial public offering is when a private company sells shares to the public for the first time. The mechanics are you have to draft the registration statements or prospectus, which is an S1 in the US, or it's a prospectus with SEBI, the regulatory authority in India. It discloses financials, risks, management, and your business model. And then you have to get into due diligence, where lawyers, your accountants, bankers will scrub every detail because your disclosures to the public are regulated by law. So you need to make sure everything that you're putting out there is factually correct because when someone's taking a risk on your security, the government wants to make sure that they are taking the risk with their eyes wide open. Then there comes regulatory review, which is through the SEC or SEBI in India, which reviews the offering and offers comments. Then the next step is the roadshow, where you are marketing your securities to investors. And finally is the pricing and listing. So you are pricing your shares with the help of your underwriters, your bankers. The shares are allotted and then they're listed on the stock exchange.
Wonderful. And so to summarize, disclosure, vetting, marketing, then launch. Is that right?
That's exactly right. And each step is heavy with legal. You've got tons of compliance and precision level drafting.
And what are the pros and cons of going public?
So the pros are you have access to a huge amount of capital. You have liquidity for the founders, the early investors, and it's also a brand building move where you're building a huge amount of credibility. The cons are it's very expensive. The average IPO in India costs between $1 and $1.5 million US, while in the US, the average IPO costs $4 to $7 million just in legal, accounting, and underwriting fees. And that's just the upfront costs. Once you're public, there are ongoing compliance costs, quarterly and annual reporting, audit fees, governance, and investor relations.
Interesting. So it's scale, but it must come with a heavy compliance burden, right?
That's right, which is why many companies consider private alternatives, like in the US, the Regulation D offering.
So Reg D offering, is that private placements you're talking about?
That's exactly right. So instead of going into the public market, you go into the private market with accredited investors.
Interesting. So what is this actually involved and why is it a good alternative to an IPO?
Regulation D is an SEC exemption that lets companies raise money privately without a full IPO registration. It's faster, cheaper, and it's less public.
Interesting, interesting. So I'm a company trying to raise, let's say, $10 million. I can, instead of having to go through all this compliance and, pay maybe hundreds of thousands of dollars in legal fees and compliance fees, I can raise money from accredited investors on a private level and potentially, do a lot faster and without all the compliance headaches.
That's exactly right. So the process is straightforward. We would draft a private placement memo, which discloses the company's business, risks, and terms. It's similar to what you would do with an S1 for a public offering, but it's much less involved. Then the second step is you sign your subscription agreement with investors based on the investors becoming aware of your risks, which you disclose in your private placement memo and your business model. Then you would file a simple Form D with the SEC within 15 days of the first sale. It's a simple form that your attorneys file for you. And then you have to comply with state blue sky notice filings, which means even though the SEC grants the exemption, many states still require companies to file a short notice and pay a small fee if their residents invest. It's how state regulators keep visibility into private offerings.
Interesting. And who can invest? Can anyone write a check?
That's where accredited investor rules come in. The government is very careful when it comes to who can invest because they want to make sure that the person investing is not going to be defrauded, that that person has the exposure to deals to be able to evaluate a deal well. So, under Reg D, most investors must be accredited. That means an individual with over $1 million in net worth, excluding their primary residence, or income over $200,000 in each of the last 2 years, or $300,000 with a spouse, expecting the same this year. Entities as well, like banks, VCs, or companies with over $5 million in assets, and now certain licensed professionals, like holders of a Series 7, 65, or 82 licenses.
Interesting. So the logic is these investors are sophisticated enough to understand the risks, so the SEC doesn't require as many protections. Is that right?
Exactly. The theory is investor sophistication substitutes for regulatory oversight.
And what are the pros and cons of a Reg D compared to an IPO?
Well, the pros are speed. You can close a round in a matter of weeks, cost, which is far lower than an IPO, and privacy. No need to open your books to the world. The cons are there's a limited investor pool. You can mostly market these to accredited investors. There's illiquidity, securities are restricted and they can't be freely traded. And there's a liability risk. If the disclosures are misleading, even sophisticated investors can sue.
So it's not actually free money. You still need to be pretty buttoned up legally. And it sounds like some risks are there.
Absolutely. Reg D offerings succeed when companies treat them seriously with solid disclosures, proper filings, and clear, compliant investor communication.
So effectively, there's a lot of pros for people who are raising maybe not as much, maybe don't need to hit the open markets and have all this disclosure. Obviously, with your public company, there's a lot of compliance, a lot of updates you need to make, especially with the SEC filing 10Ks and quarterly and annual reports. So if you don't want to go through all that, you can go through a private round of financing, which is generally for smaller amount of money, but still significant in many ways. But there's still a lot of risk there. There's still securities laws compliance, and it sounds like some of the risks also of not complying is that there's criminal, civil penalties that you could be facing if you don't do it right. Am I correct?
Absolutely, that's right. But that's where we come in. We are there to advise our clients. If you want to raise, for example, $1 to $5 million, that's a type of round that makes sense to do privately. Let's say you are opening a restaurant, you're opening up a software business, you're opening up your company, and you need capital to execute on your business plan. I mean, there are multiple ways to get money in the door. One is a loan through financing, but another very legitimate way is this private placement offering. And I would just advise that this is a great way to raise capital, but just know that you have to be compliant. And as long as you're willing to play that game, it's an excellent way to raise capital.
Absolutely. And it sounds like, also just disclosing the risks, right? Because fundamentally, the SEC is there. So investors, smaller investors especially, don't get taken advantage of. This is why we have all this compliance in the first place. So, you need to make sure that you are disclosing the risk correctly. And if you fail to disclose a risk and it ends up being a bad investment, you could be facing serious consequences, criminal, civil liabilities, and the many tens of hundreds of thousands of dollars, maybe millions, depending on how much you raised. So just something to be really cautious of and careful of, and that's without all the other legal fees that you're going to be incurring as well. So we want to help people avoid these issues, do it the right way, and make sure that they are compliant when raising money.
And I just want to draw a distinction for our listeners that let's say you have a business plan and you disclosed every possible risk, and one of those risks came to fruition. And as a result, your business failed. That's not a reason to be subject to penalties necessarily, as long as you were honest, transparent, upfront, and you were compliant. The thing that the government wants to ensure is if you're going to take a risk, you know that your capital is at risk. You could lose all your money when you invest in a business. And as long as you are sincerely operating that business without defrauding the public or anybody you're selling your securities to, the government is essentially saying, we understand that there are risks in business, this capital is at risk, but you have to be upfront and sincere with the people buying the security. So the failure of your business isn't the problem and not the reason to not do this. It is an excellent way to raise capital as long as you are willing to be sincere and transparent. And Pankaj, we're seeing a lot of these Reg D offerings now in the real estate market, presumably because it's a proven business model, tried and tested. And when you have an operator that is capable and has shown a proven track record, we're seeing operators in real estate raise funds to go in and buy apartment complexes or homes for rehab projects. So we are seeing real estate actually represent a very large number of Regulation D offerings in California.
That's amazing. Yeah, really, really good insight. I'm sure there's a lot more to discuss about that in the future, which we'll definitely get back to. So, just wrapping up, Sahil, we've covered a lot today. We've covered tariffs, we've covered IPOs, we've covered Reg D offerings and the intricacies involved there. If you had one piece of advice for business owners navigating all this, what would it be?
I'd say build flexibility into your strategy. Whether it's international trade shocks like tariffs or raising capital in the US, the rules change quickly. The best companies are the ones that prepare for multiple paths so that they can pivot when things shift.
That's great to note. Sorry, cut. Sahil, that's a great note to end on. Thank you so much for joining us and providing your feedback and insight on your travels and understanding the Indian market and what it's like there on the ground when launching an IPO.
Thanks, Pankaj. It is such a pleasure to get to talk about it and share this with our listeners.
Wonderful. And thank you all again for listening to Letters of Intent. I hope you've enjoyed today's conversation. Subscribe, share, and join us next time as we continue exploring the intersection of law, business, and innovation. You can find us on all the leading podcast channels as well as on YouTube. We are also on social media, Letters of Intent, as well as on Carbon Law Group or at Carbon LG on Instagram, on LinkedIn. So you can find us pretty much anywhere on the internet. And we encourage you to comment if you want to hear more on certain subjects. I have questions. We're always happy to provide answers to any questions that listeners may have. Until next time, I'm Pankaj Raval, and thank you, Sahil Chaudry, for joining me as my co-host. And this is Letters of Intent.